Welcome back to the only show that reads a company's financial statements the way they deserve to be read, with a scalpel, a magnifying glass, and absolutely no mercy. I'm Vic. That clammy, smiling expense report with ankles is Bud. Bud runs a company. Bud would like you to look at one number, nod politely, and go home.
Net income was up, folks. Everything's fine. Look at the nice round number. Don't look at the other numbers. They get lonely.
Everything is not fine, Bud. Everything is never fine. It is all in here. This is a financial statement. It is not a single number. It is a trail of evidence. What the company owns, what it owes, what it earned, what it spent, where the cash went, and what management hid in 12 pages of footnotes written in 6-point mosquito handwriting.
There are bodies in the footnotes?
There are always bodies in the footnotes, Penny. Today, we are reading the statements from the top line down to the last slimy disclosure. Roll the guts. First rule of the autopsy. Never stare at one period like it floated down from heaven on a velvet cloud. Financial statements are usually comparative. They put the current period beside earlier periods so you can spot what changed.
So I just look for the biggest number?
No! You look for the biggest change! A balance sheet commonly shows 2 years side by side. Income, cash flow, and equity statements often show 3 years. That lets you compare a company against its own recent history before you start making grand speeches about what it means. Imagine Bud's sales rose from 1 year to the next. Great, but why? Did he sell more units, raise prices, buy another company, change the way he records revenue, get rescued by a lucky economy, sell off a division, borrow enough money to make the office smell like fresh carpet and panic?
Growth is growth, Birdman.
A number is a symptom, Bud. The cause is the diagnosis. Comparative statements help you see patterns. Revenue rising while cash from operations slouches. Debt swelling faster than assets. A margin shrinking one suspicious year at a time.
So comparison gives me questions, not answers.
Exactly. A 2-year comparison does not solve the mystery. It tells you which drawer is leaking green smoke. Then you open that drawer. Watch the units too. Thousands, millions, and billions can make the same digits mean very different things. Watch the dates. Watch whether a period is a full year, a quarter, or some weird stub period that Bud calls strategically transitional.
It was a very short year, very petite, a little year in a tiny hat.
If the periods are not comparable, the comparison can lie to your face with excellent posture. Secondly, statements can wear different outfits. Companies do not always wear the lines in the same order, use the same labels, or put the same subtotal in the same place. This year I call it adjusted glow-up income. Last year I called it profit. Both have vowels.
Next come operating expenses. These are costs of running the business that are not directly the cost of the inventory sold. Selling costs, general and administrative costs, research and development where applicable, and other business supporting expenses. Peel them away and you get operating income, a useful subtotal for the profit generated by the company's central operations.
Is operating income the final answer?
No, Penny. The carcass has layers. Next comes the weird stuff. Interest income, interest expense, and gains or losses that may be outside the core operation. The presentation varies, but the idea is that non-operating bits can move the number between operating income and pre-tax income.
It is all one big family of numbers.
Some family members live in the attic and eat extension cords. Separate them! Then the tax leech takes its cut. Income tax expense is deducted from pre-tax income, leaving net income. That sad little raisin at the bottom is the number Bud wanted you to see before we began.
So a high net income can come from more than one thing?
Precisely. It can reflect sales, cost control, operating strength, interest, investment gains, tax effects, and accounting presentation. That is why you do not just salute the bottom line. You walk down the staircase.
Say it with me, everybody. Net sales minus COGS equals gross profit. Minus operating expenses equals operating income. Plus or minus non-operating items equals pre-tax income. Minus income tax equals net income.
I like the top number better.
Of course you did. It had fewer teeth marks. Sometimes a company sells, abandons, or otherwise exits a major component of its business. That is when the statement may separate discontinued operations from the results of the business that continues. We did not lose a division. We put it in a bucket to think about itself. The point is predictive value. If a major component is gone, its past income or loss may not describe the company you are evaluating going forward. A presentation can show income from continuing operations, then separately show discontinued operations, often including the operating result of that component and any gain or loss from disposal, subject to the reporting rules that apply. So I should not mash it all into one number? Not if you were trying to understand the remaining business. Continuing operations are the healthy body still walking around. The discontinued component is the severed business line in the bucket. Separation is not an insult, it is information. You want to know what earned money last year, but you also want to know whether that earning engine is still attached. The bucket has excellent future prospects. The bucket has a handle. It is not a strategy. Next, earnings per share, or EPS. Net income tells you the total result for the company. EPS relates earnings to the shares that have a claim on them. In a simple basic formula, EPS equals net income available to common shareholders after preferred dividends were applicable, divided by the weighted average common shares outstanding. Why weighted average? Why not just count the shares at the end? Because the share count can change during the period. If Bud issues new shares halfway through the year, those new shares were not around for the entire year. The weighted average accounts for how long shares were actually outstanding. More shares means more friends. It can also mean a smaller slice of the reason per share. Basic EPS generally excludes potential dilution. Diluted EPS looks at the potential effect of securities or contracts to become common shares, if they are dilutive under the applicable rules. The formula is not a stock price prediction machine. It is a way to express earnings on a per common share basis. And like all formulas, it is only as meaningful as the quality and persistence of the earnings you put into it. Net income is a major performance measure, but some accounting systems also present comprehensive income. Net income plus other comprehensive income, often shortened to OCI. Is OCI just another word for income? Not exactly. OCI generally captures certain changes in equity from non-owner sources that the formula does not put in net income in that period. The detailed items in presentation depend on the reporting framework and effects. The simple relationship is comprehensive income equals net income plus other comprehensive.
Gross profit percentage is gross profit divided by net sales. It tells you how much of every sales dollar remains after the direct cost of the goods sold before many other expenses start chewing.
70% margin, baby! Put it on a billboard! Put it on my suit!
A high gross profit percentage can suggest pricing power, product differentiation, favorable sourcing, or efficient production. It can also simply reflect the business model. The number becomes more useful when you compare it across time, against competitors, and against the industry context. But do not fall in love with it. A fat gross margin is not the same thing as fat net income. Research, advertising, administrative costs, interest, and taxes still take bites.
So this beautiful cake could be hollow?
Exactly. Gross profit is a layer of the story. Delicious layer, not the whole cake. Now we follow the fluids, the statement of cash flows. Profit is important, cash is also important. A company can report income and still have to answer the awkward question, where is the cash and what did it do? Cash flows are commonly classified into 3 categories: operating, investing, and financing activities. Operating activities are the cash effects of the company's principal revenue-producing activities and related operations.
This is where you see the movement between accrual-based profit and the cash actually generated or used by the business. Investing activities generally involve acquiring or disposing of long-term productive assets and investments that are not cash equivalents. Buying equipment, cash outflow from investing. Selling an investment, potential cash inflow from investing. Financing activities are about the capital structure. Borrowing and repaying debt, issuing or repurchasing stock, and paying dividends, among other applicable items.
3 pipes! All of them lead to me!
1 pipe can also lead out of you, bud. That is the part you keep forgetting. Why does classification matter so much? Because the category helps you understand the nature of the cash movement. Cash generated by day-to-day operations is not the same thing as cash raised by borrowing. Cash spent buying equipment is not the same thing as cash spent repurchasing shares. One total, without the buckets, can hide the entire plumbing system. And non-cash investing and financing transactions can still matter, even though they do not appear as cash receipts or payments in the statement itself. Those are commonly disclosed separately, so you understand transactions that changed assets or liabilities without the cash pipe sloshing. The operating section can be presented using a direct method or an indirect method. The direct method focuses on major gross classes of operating cash receipts and payments. The indirect method starts with profit or net income and reconciles it to cash from operating activities. Why would net income and operating cash be different? Because accounting is often accrual-based. Revenue and expense recognition do not always happen at the exact moment cash moves. The indirect method adjusts net income for non-cash items and for changes in operating assets and liabilities. Depreciation is a classic non-cash item. It reduces accounting income as an expense, but does not represent a fresh cash payment in that period. So in the reconciliation, it is generally added back. Changes in accounts receivable are another clue. If customers have been reported as owing more money, the company may have recognized revenue without collecting all the cash yet. Other working capital changes can push cash from operations up or down relative to net income.
The machine is broken! It says my profit became less cash!
The machine is not broken. It is asking where the money went. Net income is not a synonym for operating cash flow. They're related, they talk at holidays, but they are not twins. Welcome to the fine print dungeon, the notes to the financial statements. If the face of the statements is the skeleton, the notes are the ligaments, labels, and locked basement door. The notes can explain the accounting rules and policies the company applied. They can break broad line items into detail, segment information, geographic revenue, property and equipment detail, unusual transactions, or the pieces hidden inside one big number. And they can discuss financially relevant matters that may not appear as a recognized balance sheet amount in a way a casual reader expects. Commitments, contingencies, legal matters, and other disclosures necessary to understand the statements. So the notes are optional reading only if I have a quiet weekend and a sandwich? No, the notes are part of the financial statements. The statement line tells you that something happened. The note often tells you what it is, how it was measured, what assumptions went into it, and what may happen next. The print is very small. Maybe it'll be too shy to bother you. I brought a magnifying glass with a label taped to it.
One special drawer in the dungeon holds the significant accounting policies. These matter because more than one acceptable method or estimate can affect how a company portrays certain transactions, subject to the rules of the reporting framework.
Does that mean companies can just pick whichever answer makes them look pretty?
No, it means accounting requires judgment within standards. You need to know which policies and assumptions are significant, whether they are applied consistently over time, and whether they make comparisons between companies more complicated. Think of 2 kitchens with the same ingredients. One uses a different recipe. You may get 2 different looking dishes, even though both cooks followed acceptable instructions. That does not make either dish fake. It means you must understand the recipe before declaring one restaurant better.
Mine has more garnish.
Yours has a parsley hedge growing through the auditor's chair. Policies can affect comparability, consistency, and ratio analysis. If something changes, look for the disclosure explaining what changed and why. Supplemental notes disaggregate broad classifications. They explain segments, unusual transactions, commitments, and legal matters. They can reveal what a tiny statement line is actually made of. If it is not right on the face of the statement, does it
Matter less? Not necessarily. Off the statement is not the same as not real. Some information is disclosed because it is important to understanding the company, even when it does not meet the criteria for recognition as a particular balance sheet amount, or when the single-faced line is too broad to teach you anything useful by itself. The practical habit is simple. Read the statements and the notes together. If you only read one, you have not read the whole thing. I prefer readers who stop at the cover page. Of course you do. The cover page does not have the gremlins. Public reporting includes required disclosures. Companies may also provide voluntary information, product category detail, customer trends, strategy, operational measures, long-term drivers, and management's narrative about the business. Extra information sounds good. It can be, but more words are not automatically more clarity. Ask whether voluntary disclosures are balanced, comparable, and supported. Are they consistent with the financial statements? Do they explain both favorable and unfavorable developments? Are definitions clear? Can you compare the metric across periods? Or did Bud invent a new measuring cup the moment the old one started looking embarrassing? We call it enthusiasm-adjusted customer sparkle. That is not a metric, that is a candlestick. Voluntary disclosure can provide valuable context. Just evaluate it with the same skeptical attention you use everywhere else. Substance over spin. Follow Major Chamber of the Autopsy, the rule book. Many companies around the world report under International Financial Reporting Standards, or IFRS, developed by the IASB. U.S. public company reporting commonly follows U.S. GAAP, with securities reporting requirements layered on top.
Are they completely different languages?
No, they're more like related accounting dialects. They share broad goals and many concepts, but specific recognition, measurement, presentation, and disclosure requirements can differ. Standard setters also work on convergence and improvements over time. For example, both frameworks require cash flow classifications around operating, investing, and financing activities. But details can differ, so you should not assume that a familiar-looking line item has identical treatment without checking the framework and the company's disclosures. Can I compare them by squinting really hard? You can compare them after you know the framework, the policy choices, the periods, and the definitions. International comparison is not impossible, just requires that you read the label before you read the canned E. That feels like good advice beyond accounting. It is the best advice we have ever given. And let's bag the evidence. Compare periods, but ask why they changed. Read the labels, but understand the economics. Walk the income statement from sales to net income instead of worshipping the bottom.
You do not need to memorize every footnote on site. You need to ask better questions, one layer at a time.
And if the questions get too hard?
Read the footnotes.
I knew you were going to say that.
Goodbye, Bud. Goodbye, Penny. And remember, never let one shiny number drag you away from the rest of the carcass.